Welcome everyone to live trading strategy workshop from Tio Markets. I'm Jan Muta, your chief market analyst here, and I'm gonna take you through some very important stuff today. We have some basics and we have something a little bit more advanced coming because this is a two-part webinar. The first part will take place today and then we'll continue on Friday with those that deposit after this webinar. So we have allocated about half an hour for the presentation and then about 10 to 15 minutes for Q&A after that. Obviously, we can chat longer if you feel like, and if there is a lot of questions, we can obviously cover those. But so we try to keep the presentation to half an hour so that those people who are here just on their lunch break, they can see the presentation in full. Okay, some of you, if you haven't been following my analysis before, you might be wondering, why should I be bothered? Why should I follow this webinar? Why should I go to tiomarkets.com/analysis and read the stuff there? Here are some reasons for you. We are hitting the targets on a weekly basis, and I'm writing very basic, simple analysis which is based on multiple time frames, and I try to condense the analysis so that you can get the most important stuff out from it and incorporate this into your trading planning. We don't provide investment advice, but you can use what we do, what I do, to incorporate into what you are looking and seeing and analyzing, and hopefully that will help you in making trading decisions. Anyway, just today we hit both targets 1 and 2 in Euro USD, and we hit the targets, target 1 in S&P 500. S&P 500 analysis was published yesterday. So you can go also to our YouTube channel and register there so you stay updated with all the videos. So very briefly, I love this feedback. So you have no idea. I'm really grateful for the content you share with us. And the reason I love this is that I love to help people to grow and learn and become better in what they do. And because I have about 20 years of experience in the markets, so I have some stuff to share with you, which I know that helps you guys. And obviously, I want you to remember that anything and everything here is just opinions only. It's for marketing purposes, educational purposes, and is not investment advice. So all the trading decisions that you make, they are based on what you think is relevant, and you might want to incorporate my analysis into your thinking and into your trading plan if you want to, but we don't give advice. We don't give recommendations. So you should only watch this presentation if you agree with this disclaimer. Very briefly, my background is in, some of it is in institutional side and some in brokerage, FX brokerage. I've been in the retail side before, and now in my current role as the chief market analyst for Tio Markets, it is the market analysis and trader education that I'm using to support your trading. Tio Markets wants you to grow as a trader, to become better. And this is why they have me here to help you. And I hope that you make the most of it. Go to the YouTube channel, go to tiomarkets.com/analysis and make, just take advantage of the good stuff that we provide to you. As I said before, this is two-part webinar. We have 2 workshops this week. If you have questions, feel free to type them into the chat box there. And if I have a moment and I see the question there, I'm more than happy to cover it. If not, then we cover it after the presentation itself. So we're going to cover trade types, market timing tools, how to trade around the US elections, which I'm sure many people are interested in at the moment, how to place stops and targets, position sizing, and then how to use indicators in trading strategy creation. Obviously, there's so much more to cover. You can't ever cover everything that you should in one single webinar. So that's why we have 2 webinars this week, and then we have more in a month's time. But I hope that by combining what you read on our analysis page and what you see in our YouTube videos, and if you combine those with the stuff that you learn here in the webinars, then you will be able to grow as a trader. And I'm pretty sure if you work on it, if you make notes, if you ask questions, you will grow, you will get better. So let's go into trade types. And before we touch trade types themselves, let's talk about something, 2 concepts that are key in understanding any trading strategy there is, because there are unlimited amount of different trading strategies and approaches, but all of those at the end of the day are either momentum strategies where you try to catch the existing momentum when the price is moving higher. You try to find the spots. You either trade the breakouts or you find the spots where the market is trying to or is actually resuming the original direction. You try to identify those bits and then move with the markets. In the academic literature, momentum is known as a very pervasive strategy. Momentum is not a strategy, but a phenomenon. So this phenomenon is recognized in 60s, 70s, 80s, 90s. It is still relevant today. Wherever you have free markets, you have momentum. So this is just good to understand that there is 2 types of, or 2 phenomena in the markets. One is momentum and the other is mean reversion. Mean reversion refers to the fact that somewhere in the middle, you have a mean. Mean isn't exactly the same as average, but if you average this range, this price range, somewhere here in the middle is the average or the mean. Without going into the definition of mean, etc., it is sufficient for you to understand that mean reversion refers to range trading. We know it as range trading. Whenever the market hits resistance and starts to turn lower, it is reverting to the mean. Then it hits support and reverses, then it's reverting to the mean. And again, and again, and again. So basically you are buying at support, selling at resistance. And now when you are thinking about your trading strategy style, what do you want to do with the markets? What strategies do you want to create and follow? Then you have to decide between these 2 first. Are you more interested and in tune with strategies that take advantage of momentum phenomenon? So basically, here you have to think in terms how often I'm going to be there to catch these moves. Am I going to be there when the market breaks out? Am I going to be there when the market retraces and then starts to move back in the direction that I was originally interested in? Or is it that because of work engagements, family, hobbies, etc., I cannot be there all the time? So then you might start to think, okay, if I can't be there to catch the intraday trends, maybe I can do this with the daily charts. Maybe I can look at the trends in 4-hour time frame, daily time frame, weekly time frame, and catch those bigger moves. They happen not so often, but they are bigger when they do happen and when you happen to catch them. Or maybe somebody has more time during the Asian session when the markets aren't that volatile and when they are ranging more. Maybe this person wants to sit at the computer and feels very confident at buying at support, selling at resistance, making 10 to 20 trades per day, and that's it. Taking small profits and leaving the desk without any positions open. Because obviously when you're range trading, you can't expect the market to move like market would move when there's a momentum going on. Obviously there are strategies that combine these two elements, and we can certainly look into those more closely. But this is an introduction on what you need to understand about how the markets behave. And it might be, obviously I'm using here an uptrend as an example for this, just to simplify things, but obviously the same applies to the downtrends. The market moves down to the downside, swings about, breaks supports, and then that's a breakout kind of trade on its own. But the idea is that because the markets can either go up or down or sideways, there is no other alternatives. That's why every trading strategy is based on these two concepts. So whether you are discretionary, systematic, hybrid trader, or if you're scalping, trying to get 10 pips, or day trader trying to get 30 to 50 pips, or swing trading, whatever you do, just keep in mind that this is the theoretical framework that you are dealing with. You only have ranges and you only have those directional moves, either mean reversion or momentum. So, what tools do we have for market timing? Obviously, this is very basic stuff because I need to cover this so that those traders and clients who are not very experienced yet have an idea. So moving averages obviously help us in recognizing the trends, and we can have examples later on if we have time, either today or Friday. And then oscillators, they, for instance, RSI and stochastics, they are really most useful when any market is moving sideways in a range. You have support below, you have resistance above, and the market keeps on bouncing up and down between those two levels. So that's when the oscillators are useful. If you try to sell when an oscillator goes overboard in an uptrend, it's not a great strategy because oscillator isn't really meant to be used that way. Because if the market is trending up, oscillators most of the time are bouncing between, say, 50 points level and the overbought area. So market might be overbought for a long time. So it doesn't make any sense to go and short or sell on a market that is trending up and then it is overbought as that's the way the oscillators are built. So any indicator, for those who are new to this, they are just derivatives of price. There's nothing mystical about them. If price does something, the oscillator will follow. So oscillator isn't leading the price, but price is leading the oscillator. So later on, when you learn to read price action, you might not need the oscillators anymore, unless you go into building mechanical trading strategies where you might want to use, for instance, RSI to define when the market is, for instance. Okay, then obviously support and resistance levels, Fibonacci retracement levels, candle formations or price formations, all of these are market timing tools, and I'm going to show you how to use them. And if you have any ideas on that you would like to add, feel free to type in to the chat box. And if you have any questions, I'm more than happy to explain in more detail what I'm saying. So, until this far, tell me, what do you think? Has this been useful or is it too basic? I would like to know your opinion here because it helps me in the future. Obviously, I don't want to bore you with some details that are very, very basic for you. Thank you, Chen. Thank you, Jen. Anybody else? You can type in while I move on. So let's go into the question of how to trade around the US elections. It's very possible that we have results only in a few days' time because of the increased mailing votes, because the increased amount of votes by mail, we might not know who the president of the USA, the most powerful country in the world, is until all the postal votes have been counted. So it might be only a few days later. So this is interesting. It's obviously bad for the country. It's really bad. It creates uncertainty, but for traders, it creates opportunities because obviously uncertainty means the traders don't know exactly how to incorporate or what to incorporate into their analysis, and that creates volatility and more nervous markets. And under these circumstances, you often see it's liquid markets like USD and yen, Japanese yen, that benefit. They are safe havens, they are liquid markets, so they are easy to go in and out, even with huge amounts of assets. And at the same time, the other end of the spectrum, the more riskier, and if we talk about now about FX mainly, we have commodity currencies that could swing about quite a bit. They are risky. So one very interesting idea for tomorrow, if we get something that wasn't expected, say at the moment the polls are indicating that Trump will lose, and some of that might be built into positions already. But if he happens to win, maybe the big traders have to reposition themselves, and that creates volatility. So it might be a very interesting idea to combine yen pairs or yen crosses. It's kind of combine the commodity currencies and yen. So let's take a look at what happened in November the 9th in 2016. And I have a chart here, grabbed a screenshot of 4-hour Aussie yen chart. So roughly here, somewhere here, the news hit the market that it is actually Trump won the presidency. The market plummeted and then dropped higher very quickly. So first of all, we have one currency like Jap yen that is used for people to position for safety. So obviously, Aussie yen goes down when people are buying yen and selling Aussie, right? So Aussie goes down against yen big time, and then the reverse takes place and the market starts to trend higher. So I'm thinking we might have, and obviously I don't know the future, I can't promise you anything, but I'm thinking there's a good chance that tomorrow, if there's going to be big volatility, it's going to be in yen pairs that are where you have commodity currencies on the other side. So how would you trade something like this? Any ideas? You can type in your answer or idea in the chat box. This is obviously kind of difficult to trade because the market moves so much and you don't know exactly where it's going to reverse. So any ideas? How would you trade this? The market is plummeting. Oh, Jen is saying, sit on your hands, stay in cash, stay out. That's a trading decision. Thank you, Shen. That's a trading decision. I mean, if that's part of your strategy and that works for you, great. Now that I have Shen there talking to me, can you tell me where would you engage a market like this? Where would it make sense to start trading again? If you stay out during this spike, where would you start engaging with the market? And while you type in, if you want to type in, I'm presenting a couple of ideas. So basically, when the market moves like this, it makes sense to look for higher time frame supports and resistances. Sorry, I wanted to show you this. Here we have CAD yen, Canadian dollar against Japanese yen, 4-hour time frame again. See how this market again plummets because people are buying Japanese yen like crazy because they think this is going to ruin, this is going to be the end of the world. Trump presidency is going to ruin everything. So they are selling Canadian dollar against the yen. And the market goes to the low from, sorry, oops. So the market goes to the low from, a daily low from 26th, penetrates it a little bit and then moves higher. Shabu is saying you might stay out. However, if it might be better to jump in when the price starts rising, maybe using tighter stops. Thank you. So two opposite views here, and I love it. Thank you, guys. Both are very relevant comments. So before I go to what I had in mind to suggest here, let's address what Shabu just said. So you might want to jump in when the price starts rising. Sure. The trouble here is, how do you define price is rising? Sometimes, and let's generalize this a bit, because not every situation is as clear-cut as this. When the market goes here, it starts to rise and keeps on rising, and then keeps on rising and keeps on rising. So obviously, we have to decide, how do we define a rising market? Do we look at 1-minute chart? 15-minute chart? Do we look at a 4-hour chart or a daily chart? So I think the correct answer from my experience is that follow different time frames. Try to get an understanding of what all the markets are doing in sort of 1 hour, 4-hour time frames, or 15-minute might be the lowest you want to go, because after that, below 15 minutes, it's going to be very much just noise, and it's difficult to understand what's happening if you look at very small time frames. Jabu is suggesting that maybe above 76. Yeah. In this case, that would have been great. Yeah, the market just keeps on moving higher and buying would have worked. But sometimes the market, if you buy above 76, market goes to this recent support, which could be resistance, and then rolls over and starts to test these lows again, or even goes lower. So it is difficult. I'm saying this because none of the situations in the market are exactly similar. But in order to avoid failure, I mean, in my experience, trading is a lot about avoiding total failure. If you are very binary in your approach, what's the biggest binary bet that you can make in life? I think you can maybe the biggest bet is that you walk across the street when it's busy, there's cars going back and forth. You go there blindfolded and you just walk, and you either get killed or you don't. So that's the biggest binary bet that you can make. But when it comes to trading, the biggest binary bet is obviously you take all the money you have, you sell your or mortgage your house, you take all that money and you trade all that money in one single trade. Now that is stupid. That's very arrogant and stupid. Never ever do that. But I'm saying this so that we can understand that there are shades of what's the word? Either you can be binary or you can move away from this binary approach as much as you can. And one of the ways to decrease the level of the level of danger that is created by this binary approach. And one of those methods is scaling in and scaling out. So what you may want to do in a situation like this, you see a support, you see market approaching a support, and when it's fairly close to the support, say around 76, you start to buy very little, very small amounts. And you think that, okay, if the market is going to go to 74, I'm out. And I don't want to lose more than X amount of dollars or X amount in percentages. And then the market hits the supports, goes a little bit below. And once you see the market moving higher, you keep adding to your position. So I think this is the sort of when you don't know what's going to happen. The only thing that you can control is your position sizing. So then the only thing that makes sense is to control your risk, because position sizing equals your risk. So you start buying in very small amounts, and once the market turns, keep on adding to your position. And as the market goes higher, keep on adding to your position. If you are building a position that you want to keep until up here, for instance, because maybe the market up there is going to be, that's your target at the time. Because obviously you don't know all this is going to happen. But you think that if the market is going to go up there to 80, above 80 or so, you're going to come out. So you might want to build up the position, add to your position as it keeps on making money. And this is totally opposite approach to those people who keep on adding to losing trades. So obviously, down here when the market goes down, you are adding to a losing position, but you are adding very, very small amounts. And one thing you should understand is that if the market is moving like this, if there is some big event, then and the market is already pretty much oversold in weekly time frame or daily time frame, then you could expect a bigger move. If you see something happening in 5-minute chart, you can't expect that signal that you are focusing on to carry into something that is typical in a 4-hour or daily time frame. But if you are looking at the weekly picture, daily picture, and you start buying at support, you can expect there to be a pretty big move. And if you have a huge event like US presidential election taking place, then it makes sense to expect for bigger moves. Now, here are a couple of things. Big surprises create big moves, because the market participants have to reposition themselves. They have to recalculate their future scenarios and then position themselves accordingly. So you should look for daily time frame, 4-hour time frame, weekly time frame, support and resistance levels, because they are usually the ones that are seen by the big money traders also. Why do I mention 4-hour? It's because the 4-hour time frame lows, if it's a pivotal low where the market turns, it's often the same as a daily low. And then these two little rules here, buy at support, sell at resistance, they have saved me more money than any other rule. And, you know, if the market is moving higher, it's more likely to break resistances and just bounce from supports. If the market is trading lower, it's more likely to break supports and honor resistances. But if the market comes to a higher time frame, very important support resistance level, those levels could turn the market. So you need to learn to separate your 1-hour trend or 4-hour trend from a weekly resistance or support level, because that's where they often turn. Yeah, does it make sense? Can you understand what I'm saying? So if you have market trending higher, it makes sense to be a buyer at support, not a seller at resistance. If you are looking, say, 4-hour time frame, let's take a chart here. So it's let me think. Okay, before we go to charts, let's finish this slide. Scaling in decreases risk. We covered this already with that the chart example there. So you buy a little bit as the market is approaching, and then you approaching a support, and then you add to the position as the market turns, and you have some evidence of your for your thesis. Obviously, you need evidence for your thesis before you can trust your thesis. Then also, when you're trading around big events, you might want to trade smaller than usual, or like Shen said, stay out and only come into the market once the result is out, which was a great point. Don't try to anticipate news, because there's no edge in anticipating news. It's either or. It's 50% probability to get. Okay, there are situations where the probabilities change, but you don't know the probabilities. That's the issue. You don't know whether it's more probable that A will happen over B, or the other way around. Therefore, when you're trading like NFP Friday, don't place the position, don't open the trade just before the announcement. It just doesn't make sense. There's no edge. So only when the result is out, start reading the price action and then go in. You might still want to trade smaller than usual if you feel that's necessary, if you are a little bit uncertain about it. And as a rule, don't risk above 2% per trade unless you have a proven money machine. Unless you know from your track record that you are making money, you have a positive expectancy in your trading strategy, then you might consider risking 3% per trade or even 5% per trade. But the main idea is your statistics should dictate how much risk you take. So if the volatility is very high and you feel a little bit unsure, maybe you want to trade a little bit smaller than usual. Maybe it's just risking 1% per trade. Because when the market is volatile, there can be slippage. Market can move beyond your stop before your actually position is stopped out. And that is slippage. So I forgot now. I did promise to cover something with chart examples. What was it? Can somebody remind me in the chat window? Sorry, guys. I had so many thoughts going through my mind that I forgot I promised to talk about. Anybody? Can you remember? Okay. 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 Don't worry. It's my fault here. So I'm sorry. But let's finish with this idea. I want to leave this with you, and then on Friday we're going to cover more different kinds of strategies. But when you have markets spiking down and up, or up and down, like this, and if you look at Euro USD on the same day, I think it spiked up first and then down. But you might want to wait for this period of strange behavior, sort of it's a behavior that is not normal. You might wait until it's passed, until the ATR sort of returns to what it used to be. So you can see that the range here was X, and here it's still a little bit more, but soon it goes to the same. When you do this, when you wait a little bit and you go into these positions a little later, maybe 12 hours later, in this case would have been appropriate, you have more data, you have more understanding what the price action does, you have more news flow, and you can see how the price is reacting to the news. So here, for instance, you can see that the price goes beyond this high and then creates a higher low. So that should be an indication that, okay, maybe the market is going to go higher. Then a little further, you have the moving averages moving higher. They are pointing up. So that gives a reason to assume that maybe the next sort of reactionary low will be a little higher than the previous. So here we are at 80.17. Then the next one is at 81.07. So if you want to go into the market somewhere here or here, you have more information. Plus the market is not behaving strangely anymore. Here, because the volatility is smaller, you can add bigger size. So I think we've now done 40 minutes here. So sorry, I really exceeded my time by 10 minutes. But let me know what you think we should cover in the future. And also, how do you find this level of teaching? Is it too basic? Would you like to go into more details? Or does it leave questions that you would like to get answered? So on Friday, while you type your answers, on Friday, we will cover how to place stops and targets. Placing stops is kind of an art. It's difficult to know exactly what level is good enough, because if it's too close, the market might stop you out and then move in the original direction of your trade. Or if it's too far, you obviously might lose too much. Then I'm going to show you a method that will help you to place your stops in such a way that your risk is always constant and you don't get stopped out unnecessarily. So you don't have to place your stops too close, and you can still keep your risk limited. I'm going to show you how to do that. And then we talk about position sizing, of course, setting targets, where are the high probability levels for targets, and then how do we use indicators to create trading strategies. Any questions? Any comments? Okay, maybe not. Maybe if you still happen to think something, let me know in the chat box. I want to remind you that in terms of risk management, maybe you would want to have something like this in place. Especially as we have a risky event tomorrow, you might not want to risk more than certain percentage per trade, per day, per week, and then you might have a maximum risk of maybe 25% where you, after that, you decide that you have to go and look at your strategy in more detail and maybe change some things, because 25% is quite a big drawdown. Any questions? No? Okay. So I just want to, as we finish, I want to remind you that you can go to theomarkets.com and theomarkets.com/analysis, and you can you can register there, but you can also subscribe to our videos on YouTube. So go there and leave comments when you think that we've, how to say that, how you would like to see us analyzing different markets or developing what we give you there. All right, Carl, that's a good question. How to calculate the risk, or how much to risk per trade? Let's go back here. Obviously, how much to risk per trade is really a question of how much, what is your success rate? Is it 30%, 50%, 70%, or something between? And then once you see those numbers, you get an idea of how much you can risk per trade. Obviously, if your success rate is closer to 30, it means that roughly 7 times out of 10, you are going to lose money. But then those three trades probably and hopefully make more money than you lost. So in order to make sure that you make more money over those 3 trades, you should lose only a little bit over those 7 trades. Say, for instance, that if you lose 0.3% per trade with those 7 trades, then the worst case scenario is that you have 7 losing trades in a row. You lose 2.1% of your account. Then those 3 trades, they should really aim for something like 4% per trade, 3 to 4% per trade, so that you have really good positive expectancy. And obviously, if your expectancy if your success rate is closer to 70, then I have seen people who trade really well with 1-to-1 risk to reward ratio because they have a strategy that is most of the time successful. Okay, thank you, Brendan. There'll be a recording for you. Thank you for participating. It was great to have you here. So I would say, as a rule, until your strategy is really steadily making money, you don't want to risk more than 0.5% to 1% per trade. And this is one approach. This is aimed to keep your drawdowns small, so that if you have, like we all have, several losing trades in a row every now and then, markets tend to favor one kind of strategy over another type of strategy at certain times. So your strategy will have good periods and bad periods, and when a bad period hits, you don't want to have the drawdown to take, say, too big portion of your account. So if you have like one trader came to me in this was in Dubai, and he said that he's not risking a lot per trade. He's only risking 10% per trade. And I was like, man, if you have 5 losing trades in a low, half the account is gone. Then you have to make 100% to get into break even again. But that is a lot. So, but once your strategy starts making money, you can obviously go higher from the 0.5%, 1% level, maybe to 2%. But this should be a business where your own statistics are the determining factor. The feedback that you get is there in your trading statement, in your account MT4 terminal. So if you are hitting targets all the time, and if you have a high success rate, maybe you can take more risk per trade. Really good information, says Sergio. How decide temporality and how to manage each one? Do you mean how to decide what time frame to use? Okay. So for me, I tend to use 4-hour, 2-hour charts as you have seen in my analysis. I think that's the advantage there is, I'm obviously looking at weekly charts, daily charts, 4-hour charts, 1-hour charts, 2-hour charts. But when I'm publishing analysis, I'm using 2-hour charts because they give me a very good understanding. It's something that I've learned to do, and I'm very comfortable with those charts. But it's really approach of, multi-time frame analysis. What you see in my analysis is based on multi-time frame understanding of market movements. But I think this is a personality question, really. If you are very anxious and you don't have a lot of time, you might want to use something like 1-hour time frame. If you see market trending higher and then dipping down to a support, you enter a trade and maybe half an hour, 1 hour later, it has moved enough for you to take the profits. Then, if that's what you feel comfortable with, just do it. If you are like Shen, who likes to use daily charts, then obviously he's aiming for bigger moves, and the signals from daily time frame charts are quite reliable. But then you have to be willing to sit on your positions for longer period of time. And obviously, when you initiate the position, you might see the market going against you a little while before it starts to move in the anticipated direction. So you just have to figure out what suits you. I wouldn't go to 1 minute, 5 minute time frames unless you have a strategy that really works there, because they tend to be quite noisy and it's difficult to understand big trends if you are looking at a 5-minute chart or a 1-minute chart only. But if you look at all the different time frames, get an understanding where the markets are moving, and you trade, say, 30-minute or 1-hour chart, you should be fine. And on Friday we can talk about, and remind me of this if I happen to forget, we can talk about trend time frames and signal time frames, and obviously we talk about all the other stuff as well. So how do you build a strategy? This is something that we really have to cover on Friday because we are way over our time. But I'm going to show you examples on how you can, using those two ideas of momentum and mean reversal, how you can, or mean reversion to be correct, how you can take different indicators, what are the weaknesses and strengths of those indicators, how you can use those to create strategies. You can copy definitely someone's strategy if you are confident that it works. The problem usually is that you're not comfortable with somebody else's creation. At least if somebody tells you, okay, this is the strategy to follow, this works for me, then you have to ask the question, is this going to be good for me? Am am I going to be available for the markets enough to trade this strategy? Is it going to be too labor intensive? Do you have to be at your PC 4 hours every evening, and you have wife and kids at home who need attention, or you have a business to run on? So if you copy somebody else's strategy, at least what you should do is to first decide if it suits your personality and your time and schedule, and then go and back test it. Go and look at the charts in, I would say, stick to one market only. Euro USD, for instance, go and check how the price has moved in the past after those signals. And only that is the only way you can create some sense of trust with this strategy. Because at the end of the day, all the strategies are great as long as they move the markets in your favor, or if the markets are making money for you with those strategies. But when the drawdowns hit, and inevitably there will be drawdowns always. So when those drawdowns come, it's difficult to just maintain the level of trust where you have to risk your money. And this actually reminds me something. If you want to test somebody else's strategy, use a demo account first, and then go into a real account. Okay. So it was difficult to find login info today. Oh, that's a shame. I'll give the feedback to our admin people there. There is a link that you will get. I think it's emailed to you, but I'm not exactly sure. That needs to be checked. So Friday's webinar will be for those people who are depositing with TIO Markets after this webinar. And so that's where we're going to look into building strategies with indicators. And what else there is? Okay. Maybe I should call it a day now and say that, okay, go to YouTube, go to tiomarkets.com/analysis and register there. And you can also get announcements via our Telegram channel. So when there's new analysis, you get it for certain. And we also have something new. I think it's something really, which, when I started, we traded futures in London for a hedge fund. And then at the time, it was normal to pay $10 per futures contract per execution. So you buy and you sell, that's round turn $20 per contract. Now you can trade. With TIO Markets, you can trade with very low spreads, without any monthly fees, and there's no fee per trade. You only pay the spread. This is amazing. You should take advantage of this. It's our VIP accounts. Go there, register for it. It's amazing. So, thank you for this webinar, and maybe you can do me a favor. Give me a grading, 1 to 5, 1 being not so good, 5 being very good. And give me an idea how you felt this webinar was. Was it worth your time? And then it is valuable feedback for me so that I know how to develop in the future. And obviously, it's going to be a little difficult to cater for all the needs. You have people who are very new and they have to be taken into account. And then you have people who are very experienced and you have to obviously have something that will help them too. So, thank you guys. Thank you. Excellent. I'm very happy for the feedback. Thank you. And on Friday, I hope I see you there. And in the meantime, if you have anything that you want to add, if you have questions, suggestions, you can email support@theomarkets.com and ask them to pass the information to me. Cool. Thank you for your time, and I look forward to see you on Friday.